Today, we are getting into an analysis that lays out one of the most extreme risk-reward setups we've seen in a while.
Yeah, our mission here is really to cut through the noise and figure out the core arguments.
We're looking at Plus Therapeutics. The ticker is PSTV. This analysis calls it a golden opportunity at its current price, which is around 56 cents. But here's the hook, the thing that makes you stop and really look. This same analysis points to a high-end Wall Street price target of $19.
$19. And that's not just a gap, it's a chasm.
Right.
And that's what we have to dissect. When you see a stock trading for pennies, but with that kind of analyst target, you know there's a serious conflict in the story.
So what's our job today?
Our job is to understand their specific case. We have to balance the technical chart signals with the fundamental biotech promise and, maybe most importantly, the massive risk that's keeping the stock so low.
Okay, let's unpack this. We have to start with the technicals.
Yeah.
The analysis calls it the loading zone setup. It's all about the price history. To understand why 56 cents might be a launch pad, you first have to understand the pain that came before it.
You really do. I mean, the analysis goes into detail on the downside. Over the past year, this stock just got crushed.
From where to where?
It collapsed from highs near $2 all the way down to a really painful low of just 16 cents a share.
Wow.
And during that whole slide, the sellers were just completely in charge, liquidating shares, no questions asked. It was a textbook capitulation.
A drop from $2 to 16 cents is just brutal. I mean, that wipes people out. It screams that all confidence is gone.
It does. But the analysis we're looking at points to the bounce off that low, that sharp, massive recovery from 16 cents back up to this 56 cent area. They see that as the critical signal.
Okay, so what is the signal telling them?
They're interpreting it as proof, definitive proof that the sellers are just exhausted. They're done.
Selling pressure is gone.
Exactly. The smart money, or, at least the contrarians, they stepped in during that fire sale around 16 cents. So this current price action where it's just consolidating, holding around that $0.50 mark, they don't see that as hesitation. They see it as a solid base being formed.
And they call this base the launch pad.
The potential launch pad. So the technical conclusion is pretty stark. If, and it's big if that 50-cent level holds, the downside risk is now pretty limited.
Especially compared to the upside.
Especially when you compare it to the extraordinary upside baked into those analyst targets. It's a risk management argument, really. The chart suggests the worst might be over.
I get it. I get the idea of chart exhaustion. But let's be honest, technical patterns fail all the time, especially when the fundamentals are, well, rotten.
They absolutely do.
We've seen these loading zones turn into trapdoors again and again. So what is the one fundamental reason that makes these analysts ignore that devastating drop and suddenly believe in a $19 stock?
That is the right question. And the analysis admits, look, the charts just opened the door. The fundamentals are the engine.
Okay.
And the whole bull case, it rests entirely on the company's core mission and their intellectual property. Plus, therapeutics is focused on treating glioblastoma.
And that's key, glioblastoma. That's one of the deadliest cancers out there. Notoriously difficult to treat.
Extremely difficult. It's an aggressive brain tumor, highly resistant to normal therapy, and it's just so hard to target without damaging healthy brain tissue around it.
So the bet is that PSTV has found a truly new way to get around that massive biological barrier.
That's the bet.
So let's get specific on the tech. The report mentions two things, the CNSide platform and the treatment, 186RNL. What do these actually do? We can't justify a huge return on just brand names.
Agreed. So the star of the show is 186RNL. Think of it as a targeted radiotherapy.
Okay.
It's a way to deliver a dose of radiation directly to the tumor, and this is the critical part, only the tumor. It minimizes exposure to all the healthy brain tissue. It's about precision, where precision is everything.
And the other one, the CNSide platform.
That sort of complements it. It's more of a diagnostic or a tracking tool. It's designed to let doctors measure the drug concentration right there in the cerebrospinal fluid.
So it's real-time monitoring.
Exactly. And that is absolutely vital in these complex trials. It helps prove the drug is getting to the target at the right dose.
So they're tackling both the delivery problem and the monitoring problem. That's sophisticated.
It is.
And this brings us to the most crucial validation point, Wall Street. If the tech is this good, you'd expect to see it in the analyst ratings, which is, frankly, rare for a microcap that just crashed.
And this is where the analysis gets really compelling. Because despite that horrible chart, the analyst consensus is, well, it's overwhelming.
How overwhelming?
The report states there are 4 analysts covering PSTV. And all 4 of them rate it a strong BY.
4 out of 4.
Oh.
You almost never see that kind of uniform conviction in this sector.
It suggests the people who are actually digging into the clinical trial data are completely ignoring the stock price and focusing only on the science.
On the potential.
Entirely on the intellectual property and the market size if 186 RNL works. And to put numbers on it, the average price target in the analysis is around $7.50.
The high target.
The high target, the one that defines this whole golden opportunity, is $19.
Okay, let's do the math on that because it's motivating. If the stock gets to that average target of $7.50 from 56 cents, what's in a turn?
You're talking about roughly a 1,200% return.
1,200%.
And the analysis connects that astronomical number directly to this idea of life-changing potential for an investor who gets in early. The belief is that the market is just so focused on the financial risk right now that it is massively underpricing the potential outcome of those trials. They're betting the science wins out.
It's a powerful story, especially with the kind of cancer they're fighting.
Yeah.
But we have to pivot back to reality.
Of course.
If the science is truly worth $7 or even $19, why is the stock at 56 cents? The discount has to be based on an equally severe risk.
Absolutely. And any balanced analysis has to cover that, and this report does. It details the primary risk, which is the immediate financial runway.
How much runway do they have?
Well, PSTV is a small company. Its market cap is only around $76 million.
Okay.
But the most critical number is cash. They have about, $16.6 million in the bank.
$16.6 million.
Yeah.
And for a company running expensive clinical trials, that is a very, very tight runway.
It's incredibly tight. Clinical research is unbelievably expensive, and things rarely go according to plan.
So that is the trade-off. They're burning through that cash to run these trials, and since they have no revenue, they're eventually going to have to raise more money.
Inevitably. And that brings up the dreaded D word, dilution. And dilution risk is the great challenge for this whole sector. A small company issues new shares to raise money, and it just reduces the value and ownership for every existing shareholder. It can kill a rally no matter how good the science is.
So that uncertainty is the reason for the discount.
It's precisely the reason.
So how does the analysis square that circle? How do they recommend you accept this, imminent dilution risk when all the upside is based on future uncertain science?
Their argument is very pointed. They basically say that the cash burn and the uncertainty, that is why the stock is so cheap right now.
Okay, so the risk is the opportunity.
That's the argument. The analysis says if the data from the 100 and XRNL treatment keeps being positive, if they hit their clinical milestones, the market will suddenly pivot.
And what happens in that scenario?
In that bullish scenario, the market just disregards the short-term financing risk. They'll believe the future value of a cure for glioblastoma is so massive it outweighs the temporary pain of dilution.
So they're betting the data will protect the stock.
Or, if the data disappoints, the cash burn just accelerates the collapse.
It's a binary bet, a race between the lab and the checking account. Given that this must be for a very specific kind of investor.
They're very explicit about it. This is for a high-risk, high-reward contrarian investor.
Not for your conservative, income-seeking portfolio.
Absolutely not. This is for someone willing to bet that the science will dramatically beat the timeline of the balance sheet. It's an investment based on conviction, not on safety.
That is a fascinating mix of charts, clinical data, and pure financial anxiety. So to review the key takeaways for you listening, this analysis frames PSTV as this stark contrast.
A huge contrast.
On one side, you have a beaten-down chart, the loading zone. On the other, you have this overwhelming, uniform analyst conviction.
And that conviction is driven entirely by the potential of their 186 RNL treatment for glioblastoma. The price is cheap because the financial runway is tight, but the valuation target is massive because the potential medical breakthrough is even bigger.
And this raises a really important question that gets to the very core of investing in small biotech companies.
It does. The analysis weighs the technical science and the analyst hope against the very real, very imminent financial pressure of a high cash burn in a life or death race.
So what's the final question for our listener?
For you, the ultimate deep dive question is this. How long can a small biotech company maintain a consensus strong buy rating and an aggressive price target like $19?
Right.
While operating with only $16.6 million in cash to fund these incredibly expensive clinical trials against one of the most stubborn cancers known to science. It's a fascinating study. It's the intersection of scientific hope and financial reality, forcing you to weigh a potential cure against a cash runway.